Hello and welcome to the show. It is great to have you with us. My first guest wrote in a recent report that 2019 was a great year for investors, a year in which the value of just about any stock you owned went up in value. But not only has it been a great year, it has been part of the longest and most steady bull markets we've seen in a very long time. Take a look at this. The current bull market at 128 months and counting, with a total return of over 300%, is the longest on record without a 20% drawdown. So the question everyone is asking, how on earth can it keep going, and why doesn't it feel good? Here to give us a bit of perspective, TD Wealth's Chief Wealth Strategist, Brad Simpson. Thanks for coming in. It's great to have you here.
Great. Thanks for having me.
These are so some pretty spectacular numbers we just had on the screen, and you wrote a great note about this, and I love the fact there is many superlatives being used when talking about this bull market.
Yeah. It's you know, the interesting part is, you know, the returns have been fantastic, yet we're all kind of a little bit dark about it, or always this kind of prevailing doom, if you will. But so a lot about returns have to do with how, you know, what is the measure that you use to be able to figure it out, right? Yeah. So you see this big 320% return, and boy, that's been so great and spectacular. I've missed it. So we took kind of a bit of different take at it and said, you know, if you want to measure average rate of returns, you look at it that way, and you're taking kind of a one standard shorter period of time, or use of data during a period of time, and it kind of skews what you're seeing, right? So with us, we said a little bit, said, why don't we look at rolling rate of returns? And a rolling rate of return basically looks at month after month and always creates what we did, a 10-year rolling average. That's it. And so with that, you see a lot of more of the ups and downs with what makes a market go. Right?
Yeah.
So, yeah.
I'm going to just jump in here because I know we've got a chart and I want to bring it up because you included this in the report.
Yeah.
And again, instead of looking at things in decades, look at it rolling.
Sure.
And this changes you know, I'll say what people think is the outsized returns we're seeing to say they're not that outsized.
No, and in fact, if you look at you know, the first chart we looked at, saying, well, that's just it's the greatest return ever. If you go back all the way to the 1920s and then roll month by month and look at rate of returns, the best 10-year rolling period return is actually the period ending in 1959, and this has a spectacular rate of return of over 620% for that rolling 10-year period. Yeah. And then and then you kind of fast forward to this one, and so that averages out at 20% rate of return. You look at the one we just went through; it's about 13%. Yeah, let's
pull the chart up again just so people can see it, because I just want while you're talking about it, we can refer to it. But again, you're seeing that, you know, that number is just it's a lot more. You know, it's come down a bit in the last at the right end of the chart here.
Exactly. So and I think the point of that is that when we look at what we went through the last 10 years and we think it's one of the best returns we've ever experienced in terms of stock markets, it's actually one of the ones that it's somewhere right in the middle if we go back to that 1920s. And so that changes your perspective an awful lot, because we have this sense, because of all these things, the monetary policy, and we all kind of know what the drivers of that are, but a lot of this has been skewed to the last few years of the rate of returns. And if you think about it, if you think of the beginning of this decade, you know, when we were talking about 2010 and 11 and 12, like, these were dark periods, and people lost their confidence and didn't really want to invest, and returns were a lot harder to come by. So a little bit what happens when you're using average returns is, you know, you're in a 10-year relationship, but you only remember the few great things at the end, but then it's it's a little bit, right? Rolling returns really make sure that you think about, on an ongoing basis, month after month of that relationship, really how was it working for you?
Yeah. The same thing, I guess, can be said with bonds, I'm assuming. Obviously, you can use the same type of 10-year rolling return in bonds.
Absolutely.
What story does that tell when you look at the bond market?
That's when maybe even is more interesting, right? Because we're you know, everybody, I think, kind of understands where, you know, if you're dropping interest rates, we're just going to drive the returns of your fixed income investments. But interestingly is that the return that we just experienced for the last rolling 10 years for the bond market is actually in the bottom quartile of returns, again going back in longer term use of data. Actually, the best during our rolling averages, which in this one we weren't going back to the 20s, we were doing the 1970s. 1991 was the last 10-year rolling period, and if you think that was kind of the beginning of this era of monetary policy. So it tells a very different story if you look at it through that perspective. Now, why I think it's important is it takes the word extraordinary and unbelievable, and boy, because this has been such an unbelievable run, maybe I have to slow down and think about investing, or I have to. No, it's really been quite average to below average, depending on the data set you want to use.
Yeah, which then goes back to this idea that for people that they feel they've missed something, they haven't.
No.
And that's something to kind of get into.
Absolutely.
You mentioned at the top, though, the one thing with this is, though, it still feels bad. And I know in your note, you talk about part of the reason it feels bad is because of the 4 Ts, which we're not going to have, it's Trump, trade, technology, and tensions, although we did get a bit of a trade deal, started, I'll say, today.
Right.
But then you talk about some specifics on why you're still optimistic, and I do want to spend some time on those.
Sure.
Number one, you've got here is growth rebounding.
Yeah, that we definitely saw some really weak data in 2019, and particularly we saw it in the manufacturing indexes. Now I don't want to over and say these are robust and really have turned around, but we are starting to see the turn in Asia data. We're starting to see that turn in North America data. And
you also have, this is an extraordinary number when I see it, but global central banks have eased 110 times since 2018.
Yeah, how's this for a figure, right? Right now, central banks they're committing more monetary policy easing than any time since 2009. I mean, that's really quite spectacular if you think that was the height of really where we got at it. That has an impact. It gets the system flowing again, and we're starting to see that move.
Financial conditions have become accommodative. I mean, they already were accommodative.
In 18 we learned that when central banks start to step out of the way, that we struggle a little bit, and they're well aware of that now. So no matter what central bank you want to look at, you'll see them. They're very active.
And I want to end here because it's important, but I've only got 10 seconds. Valuations, you still think are attractive at this point?
I think if you're looking at the S&P 500, I think you're going to have to call that at today a kind of full valued, but it may surprise you in this upcoming year. Rest of markets, I think you could be at fair value, like Canada, or looking into emerging markets, and even European markets, though I think you want to be a little cautious there.
Brad, thank you very much.
Thank you.